In Yu-Dee Chang now. He is Principal and Chief Advisor at Money Manager ACE Investment Strategist. He is joining us from Washington, D.C. Thanks for joining us today, Yu-Dee. What do you think? The data starting to look a little bit patchy. We spent most of Q1 waiting for a pullback. It didn't happen. What should investors do?
Yeah, it's the same story, right? I think we are still in this slow growth, low yielding and low flying economy. Nevertheless, it's still growing. So that's what we think. In our area, Lisa, housing is definitely coming back pretty strongly in the Washington, D.C. area. I travel to Las Vegas quite often, not for gambling for that matter, visiting my daughter. And that economy has been coming back up a little bit as well. So I think overall speaking, the uptrend of the economy in the market remains intact. Now, as far as this market is concerned, same thing, right? We are climbing the wall of worry. This is the most hated rally in my professional career, right? As the market goes higher, everybody hates it, everybody doubt it, and that's the reason it's probably why it's going to sustain. Now, are we going to have a pullback in the month of April? Personally, I actually think we will, but I think 2 to 5% at the most, and everyone is looking to buy dips.
Okay, so how do you approach this market? Because the dips don't really seem to be unfolding, do they? And if you look at the S&P, hitting the record, of course, took a long time to get there, but it sure did. Fueled by consumer staples, surprisingly, since 2007. Consumer staples, consumer discretionary. What do? Do you keep buying into those areas? Do you rotate into other areas? What's your advice?
Yeah, I think rotating in areas is a perfect way to do this market. This market has corrected, if you have noticed. It corrected taking sectors like the housing. Housing has been very, very strong, the builders that is, but recently it went through a 7% correction before coming back up slightly also. So market in all, sector by sector, has been correcting. I think that's the way to do it. You want to find the good sectors that has the future for the longer term. Then you want to wait for a correction, a pullback in these sectors and buy into them. So rather than try to deal with the overall market, keeps waiting for a deeper correction in the overall market, you wait for the sector pullback and buy into sectors one by one.
All right, Yu-Dee, how do you position in the short term this week ahead of payrolls?
Yeah, right now we're actually pulling back down a little bit. We actually started to take some profit. Our model tells us that we still have a little bit left, upside left, that is, regardless of the payroll numbers. So if somehow we get a negative surprise on the payroll numbers, we think it might short-term trading basis being a buying opportunity. But I think on the intermediate term for investor, you're not going to miss much at this point in time. So even if you miss another 2-3% to the upside, it's going to pull back another 5-6% to the downside. You're back where you are. So I think on an intermediate term basis, we are waiting for that 5% pullback before we do some major buying again.
Yeah, such a tough market to trade. Thank you so much, Yu-Dee. Yu-Dee Chang of ACE Investment Strategist. He's going to be joining us again in just a couple of minutes. So if you have any questions for him, shoot us an email. The address is Squawk at CNBC Asia. You can also get us on Twitter. There's my handle, Shree's handle, and also Bernie Lowe, who's going to be on the show in just a little while as well. We're going for a break, 2 minutes. We'll be back. Good morning. Welcome back to Squawk Box. We are back now with Yu-Dee Chang of ACE Investment Strategist. Yu-Dee, as we were heading into the break, you were talking about what a difficult thing asset allocation is right now. In Q1, everyone called for the great rotation out of bonds. Hasn't really happened. Is this the quarter, Q2, that we might start to get the beginning of a move?
I don't think so. I actually own a lot of bonds myself, right? So that's the question I ask myself every day. Do I get out of the bond market because it's going to crash down? I don't think so. Right now, if you look at Bernanke's strategy, he's going to keep interest rates low until he sees absolutely clear sign of a stable recovery. We don't have that. So he's not going to raise rates. So I don't think it's time yet. Maybe toward the third, fourth quarter of this year, but not right now. I'm not going to sell all my bonds and rotate into stocks yet.
Okay, what's your view on the dividend plays? Because I was reading an interesting commentary the other day saying, you know what, there are a lot of people, baby boomers retiring in the United States. They're going to need money invested in assets that spin off revenue, spin off income for them, and dividend stocks is going to be a favorite play. What do you think?
Yeah, you know, that's actually been a play that's been favorable for the past, I would say, about a year and a half. But these days, if you look, even Apple gives you a 2.3% dividend, right? So the so-called dividend plays is there everywhere because these companies, they are a little afraid to expand, so they are being up at ante on their so-called dividends. So I think I like it. As a strategy, I like it. I think it cannot prevent a falling of a stock. However, it does give a little bit of stability for the stock to the stock as well. So if you find a stock you like, you think is relatively stable, and it gives pretty good dividend under this low yielding interest rate environment, it's not a bad strategy.
But is this a good time to buy Apple when you've got some of the main shareholders, the Fidelity Contra Fund, cutting its stake by 10%? They were the biggest shareholder in Apple. So even though, yes, they pay a nice dividend, yes, they might even increase that dividend, when you've got the big boys selling, you don't want to get in front of that train.
No, you don't. The big boys got too many shares of it. Contra Fund actually had about 11.5 million shares. They trimmed it down to about 10.5. So as a result, Apple fell a lot. I think you're right. I think you're absolutely right. Maybe not Apple. Apple, to me, at this price level, we're talking about a 9.5 PE with a 2.3% dividend rate. It's actually, in my opinion, fairly valued, but the momentum is not there. They lost their innovative growth story, right? iPhone, iPad. I mean, it was fantastic 5 years ago. But these days, comparing to Samsung, comparing to HTC, they're just not that innovative anymore. So I think over the short-term basis, Apple, if you don't have the stomach for it, you probably need to stay out of it for a little bit. I think a good strategy on Apple is probably start to sell put on Apple computer and start, if it dips, if it doesn't go down, then you pick up the put premium. If it does go down, then you buy it at a lower price. So buying it for dividend, I don't like. Selling put options on Apple, I actually like.
Okay, we are all out of time. Thank you so much. Yu-Dee Chang there of Ace Investment Strategist joining us from Washington, D.C. A lot of disappointed Apple investors out there listening to your comments, Yu-Dee. We're going to go for a break. Still ahead on the show.